If you had to pick one myth about ESG investing that you wish more people understood, what would that be?
So, time and time again, I'm really disappointed to see the actively blurred lines between ESG investing, values aligned investing, and impact. Because by conflating these concepts, investors and clients who are intent on making a difference are pretty misled. So, there's this false promise sometimes in marketing materials about the positive change your investments can create. So investors can be persuaded by this impact washing to allocate assets to product or strategies that don't actively create change. So when traditional firms, Wall Street firms, other big players, they sell ESG products, I think most people don't understand that those investment products are not necessarily values aligned. Definitionally, ESG research integration, it's part of an investment process to try and improve investment returns. So it's about how a company is performing in various social environmental governance measures, right? Sometimes to mitigate risk, sometimes to understand a company's opportunities. It's not necessarily tied to values, ethics, morality, mission, any of that stuff.
Hello and welcome to the Investing in Other Stories podcast. I'm your host, Margarita Tr, a former Wall Street executive, CFA charter holder, and investing educator at Finance Latte. I'm so excited about today's episode because we welcome a socially responsible investor deep in the trenches of shareholder engagement. Our guest is Sonia Kowal, president of Zevin Asset Management. Sonia manages corporate matters that range from strategy to client relationships and incorporates sustainability discussions into investment decision-making. She also oversees environmental, social, and governance research, proxy voting, as well as the corporate engagement strategies of the firm. She's a member of the firm's board and investment committee. Previously, she was a senior research analyst and head of ethical investment research services, U.S. Boston office. She was a portfolio manager and investment research analyst in the emerging markets team at Baillie Gifford in Scotland. Sonia holds a bachelor's degree from University of Edinburgh in zoology and a master's degree from the University of Stirling, Scotland in investment analysis. She's a board member of the Interfaith Center on Corporate Responsibility, a coalition of faith and values-driven organizations who view the management of their investments as a powerful catalyst for social change. She's also a board member of the Investor Advisor Association, the leading organization for fiduciary investment advisors. Sonia is also a member of the investment subcommittee of the American Friends Service Committee, a Quaker organization that challenges unjust systems and promotes lasting peace. Sonia, what an impact maker you are. I'm so glad you're here and a warm welcome to our podcast.
Thank you, Margarita. I'm happy to be here.
I cannot wait for everybody to get to know you better. You started your career in asset management in Edinburgh before you moved into environmental and socially responsible investments. Was there a moment in time where you realized, wait, sustainable and socially responsible investing is going to be my future?
Yeah, so I came to my work in socially responsible investing because I was bothered by the inconsistencies between the ethical lifestyle I was trying to lead and the investments I was making in my professional life. And I came to realize that no matter what I did at home in terms of supporting environmental or social causes, these positive behaviors and choices were dwarfed by the negative events of the investments I was making as an equity analyst and portfolio manager at a traditional firm. I became a portfolio manager. I was managing about $1 billion before turning 30, but then I was so disillusioned by the greed I saw around me, and I was not hopeful that it was possible to truly drive change within an established firm. And you can tinker around the edges for sure, but not affect the kind of radical change you need to disrupt our current paradigm of investors' irresponsibility towards social and environmental costs created in clients' names. So there were two events that inspired me to make a change in my very comfortable career. The first was witnessing my colleagues in a very serious and straight-faced discussion on the investment merits of child labor. We had a foundation client that asked us how we made sure that the companies that they were invested in didn't use child labor. And we made a few placating noises, and then we returned to our desks after the meeting and laughed at the question because it was obvious that child labor is cheap labor and lower labor costs are good for shareholders. And then I went on a research trip to visit a mining company. in the Siberian city of Norilsk above the Arctic Circle. And that place looks like a scene from the darkest part of Dr. Seuss's The Lorax. The few remaining trees there were stunted, dying, and when it snowed, the snow was black from the pollution. And there's no safety equipment for the workers, either in the mine or the smelter. And when I tried to ask questions about what I was seeing, I was patronized. And I did not at that stage have the expertise to push back on what I knew was greenwashing. And I went with a group of other investors, and they seemed so oblivious to the destruction and the despair around us. And we enthusiastically invested and make a lot of money. Those two things, those two experiences really made me think that there's this very uncomfortable irony, especially when you're investing for foundations and nonprofits, that this money is set up to do good work, but it's funding activities that are directly contrary to the purposes for which the funds are originally granted. So that cognitive dissonance that had been buzzing around the back of my head was too loud to ignore, and found my way to Zevin eventually.
Okay, I had goosebumps while you were talking because it sounded so dystopian. What an out of body experience. And I think it's important to also note that was an early decision. That was like way before ESG became even like a trend at that time, right?
Yes, it was. It was in the early 2000s.
Exactly. So way early. And it's not that you just jumped on a trendy bandwagon.
So Zevin Asset Management has been doing this since 1997. The
Hmm.
founder was doing it since the 60s. So definitely we are not trendy in any way, shape, or form. We just think it's really important.
Wonderful. Thank you for sharing that. It's really powerful. Tell us a little bit more about then when you joined Zevin, what that journey looked like, and how you think about innovating, right? You're the president. So how do you think about innovating in this space without losing your roots?
So I found my way to Zevin in 2009 as their director of socially responsible investing. And then I became president in 2014. It's been an interesting journey, especially as a woman, to work within this field. It has been for many women and many other kind of marginalized communities in the financial space, a very toxic place to work. So it's wonderful to be able to work in a place where we're all refugees from more traditional management, old-fashioned places that greenwash. We are very clear that's not what we're about. And so we're offering institutional money management as well as money management for families and individuals, for those who have this commitment to social justice and active ownership. We are particular about the clients that we work with, and there needs to be philosophical alignment with that so that we can move forward and help each other push boundaries.
How has investing in a socially responsible way evolved over the years?
It definitely does. We are always thinking about new issues because global events continue to change and educate us on society's expectations for companies. And our process also evolves then to take new and emerging issues into account. We're luckily small, so this is harder for a large firm, but our process is very adaptable. It's not rigid in this way. The results about our curiosity about the world and innovative thinking can really be easily included. So what we're known for is researching and mainstreaming emerging issues before they become widespread investment issues among other investors. The proxy voting practices of publicly traded asset managers around climate change risk. We were doing this work over 10 years ago. I think we were the first investor to file a shareholder proposal around big asset managers' proxy voting records around climate. The link between racial inclusion and executive compensation, we pioneered that a long time ago, thinking about the prison industrial complex and the link to investors. So yeah, we are proud of being on the forefront of new issues.
Wonderful. And if you had to pick one myth, and there's many, but if you had to pick one myth about ESG investing that you wish more people understood, what would that be?
So, time and time again, I'm really disappointed to see the actively blurred lines between ESG investing, values aligned investing, and impact. Because by conflating these concepts, investors and clients who are intent on making a difference are pretty misled. So there's this false promise sometimes in marketing materials about the positive change your investments can create. So investors can be persuaded by this impact washing to allocate assets to product or strategies that don't actively create change. So when traditional firms, Wall Street firms, other big players, they sell ESG products, I think most people don't understand that those investment products are not necessarily values aligned. Most educational materials, either intentionally or through ignorance, conflate the concepts of ESG integration and values-driven investing. They can overlap, but they don't necessarily. And just definitionally, ESG research integration, it's part of an investment process to try and improve investment returns. It's not necessarily tied to values, ethics, morality, mission, any of that stuff. So it's about how a company is performing in various social environmental governance measures, right? Sometimes to mitigate risk, sometimes to understand a company's opportunities. So it's a tool for value integration, not ideology. And so that's a point that's missed by many politicians, especially in the US, that are very noisily trying to undermine this practice. Using ESG integration in an investment process alone does not create any kind of impact. It's vital to making good investment decisions, but it doesn't create change by itself. And the impactful part must include the intention of generating measurable social impact alongside a financial return. So I think the onus is on the buyer to do the due diligence if they are looking for impactful investment products. And many are not. Many are just interested in ESG. But if you are thematic and you're looking at funds that create climate change resilience, choosing the right companies is important. But in the public equity space, it's not a given that they will proactively promote positive change. So it's that concept of additionality that I think is particularly tricky in public equities. Because when your manager buys a share in a listed company, typically the money goes to the seller of the stock, not to the company itself. So I don't think you can stock pick your way to impact in public equities. I think it's important not to buy just blindly into these green or socially responsible labels. It's like the word natural in food products. And in Europe, it's a little bit different because you have all the kind of legal background in labeling. Here in the US, just because a fund or a manager has ESG or SRI, it doesn't make it so.
And it's something I struggled as well. ESG has been around me, and these different labels have been around me. And even I struggle to sometimes differentiate. But for avoidance of doubt, when you look at your strategies, how do you classify them?
We have negative screening and positive screening. We have ESG because we think that's really just a given in this investment world to see the world in color instead of in black and white, to take much more information into account. And shareholder advocacy is the part where we have impact. And we do public policy work as well.
So your impact comes from not just necessarily integrating the ESG factors in your analysis, but actually the shareholder engagement. So that's the impactful part.
Correct. We don't believe that the ESG integration creates impact. Impact doesn't happen by accident. It has to be intentionally driven. We have to answer the question, why do we bother to have impact as investors? Is it to make more money? No, that's the ESG part. Or are we trying to change systemic issues by leveraging our unique voice? I'll give you a little pet peeve of mine. You've seen probably some public equity funds that claim if you invest in them, you can avoid a gazillion tons of greenhouse gas emissions. You can save millions of lives through disease treatment. I understand there's a thirst for this type of digestible, quantified reporting, but be very wary of these kinds of statistics that make these claims of individual investors' real world impact. Some in the small print, it might say something like, this is a metaphor, but most people will take this kind of reporting literally. And unlike investment returns where the marketing is so highly regulated, there's not any kind of third-party oversight regarding impact reporting. So it creates room for this types of information. And if funds could really do all the things that they claimed, the world would be saved tomorrow if we put enough money in. And we know that's not possible.
I love it. And honestly, I think this is the best answer I've heard from a professional investor on how to differentiate this. I think this could not be more clear. So thank you so much for sharing and demystifying and clarifying all of that for us. Truly.
Happy to.
So we already started touching on this, but as you mentioned, ESG has faced so much backlash already in the US. We have collected some mean tweets for you where we hear some really bold negative statements about the space, about investing through an ESG lens that I would love to hear your take. Are you ready?
Yes.
Wonderful. First things first, Elon Musk claiming ESG is the devil in response to a tweet mentioning that tobacco companies have better ratings than Tesla. What is your response?
So clearly, Elon Musk doesn't understand what ESG is. As I mentioned previously, ESG is a process for understanding how a company manages its environmental, social, governance risks. It has nothing to do with ethics. So screens are the mechanism to include or exclude a company based on its products. Two very different things. I know details aren't Elon's strong point, but I suppose an investor could make the case for screening in Tesla on a climate portfolio. But in terms of how many investors look at ESG, it's a big fat fail. Tesla has terrible governance, poor management and working environments, and really poor health and safety. So that's why you're comparing apples with oranges. And I don't think he understands that.
Just side note, just for my sake. So like the ESG ratings don't look at the end service. They look at the factors in the company.
They can, but that's something for the underlying user of the ratings to separate out. So we don't use ratings at Zevin because we think they can be very misleading and really boil a very complex topic into a small number or a rating. So those two things need to be separated.
So the way a company is rated from the actual services and products it produces.
Yes. So the products and services need to be rated separately because that's a client by client distinction to how a company is doing what it's doing.
Wonderful. Thank you for clarifying. Great. Another main tweet or quote, ESG is a woke agenda imposed by asset managers. What do you have to say to that?
If you've ever worked for a traditional asset manager, you'll know that they're anything but woke. The only thing that matters is performance. And from performance flows increased fees and increased bonuses. So if clients don't want it or the portfolio managers don't think it helps them make more money through making better decisions, they wouldn't do ESG investing. It's as simple as that. There's no agenda other than making money.
Wonderful. Another quote from a whistleblower claiming ESG investing is just a marketing scheme. And this comes from somebody who worked in sustainability and then exited and sort of blew the whistle. What do you have to say to that?
For many managers, it is true. ESG investing is a marketing scheme. I've been shocked about what some managers will say about what they do to entice clients. They've learned how to imitate the language of impact without doing much of anything, and it works. It's so disappointing to me coming from a firm with deep, authentic roots in this space that even when investment firms backpedal on ESG as a result of political pressure in the US, that clients who are taken in by their marketing efforts choose to stay with them. And I think consultants have gotten a bit better at parsing the wheat from the chaff, but they still have a long way to go beyond the marketing reports by investment firms to really understand the how and whys of ESG and impact. I think what we're seeing from many traditional asset managers who don't have that mandate for clear corporate change, but they do have this mandate to grow at all costs. They call it stewardship, which is different than advocacy and engagement. What they then do is just pushing for a change in policy at a company. But that usually results in very little actual impact on the ground. If you're only looking at things from a risk analysis perspective, you're satisfied. You see the companies check the box on a policy. Great. We did it. It's a win. Asking how companies are actually doing, what's different in the company after a policy is adopted? How is it changing the behavior to achieve a better goal? And how are the underlying issues better as a result of this? And over a long period of time. So yes, I think sometimes it can be a marketing scheme. So it's buyer beware.
Wonderful. Fantastic. And last but not least, I have a quote from Tarek Fancy, the former chief investment officer for sustainable investing at BlackRock, who said, ESG is a dangerous placebo that distracts from real solutions to environmental and social issues. What do you have to say to that?
I have a little sympathy for this one as well. I guess I would respond as a yes and. If you've just invested in a BlackRock ESG fund, you think you've saved the world, think again. So I think also Mr. Fancy is a little jaded by the type of investing that he was in charge of that maybe didn't care to change or couldn't change because it's such a big firm. Like we mentioned before, ESG on its own doesn't change anything, but real shareholder advocacy does. And real solutions include non-extractive impact investing alongside shareholders. I think there's this failure of public equity managers to listen to and engage with NGOs, community groups, and other grassroots voices to really understand the trickle-down effect of corporate or policy activities. That's hugely problematic because there's a very real risk that what investors ask for from companies could have large unintended consequences on the ground if you don't include stakeholders. And these inequitable power structures are reinforced. I think without consulting those that are the most impacted, our actions as advocates, however well intentioned, may uphold the status quo or indeed inflict further harm. So, listening to, upholding those stakeholders, we're trying to give a voice to those impacted and create better companies as a result.
Wonderful. We have to use every tool at our disposal to bring change.
Absolutely. I think our industry needs to do a much better job of engaging with them instead of ignoring their voices or patronizing them because we think we know best because we're educated investors. At Zevin, we're regularly consulting with leading environmental advocates, human rights experts, labor groups, whoever, in an attempt to inform our own investing process.
Wonderful. Makes perfect sense.
So there's a source that I would point your listeners to that's really interesting.
Yes, please.
By the Center for Economic Democracy here in the US, and it's a paper called Social Movement Investing that came out a few years ago, and it explores the practice of investing in alignment with social movements.
Wonderful. Thank you for sharing. Next, how do you integrate ESG factors into your actual investment decisions?
So I guess the why is that in combination with fundamental analysis, ESG analysis gives us clues into the potential long-term performance of a company. And it can flag risks and opportunities sometimes before they're recognized by other market players. Sometimes we discover slow improvements or disintegration that plays out over long periods of time. But also ESG factors can dramatically affect prices of securities in the short term. So it's not a silver bullet for sure, and it depends on your time period. But we have established minimum standards for some ESG criteria, and we are just really trying to figure out what's material to a company and its fundamentals over a certain period of time. Sometimes we're trying to balance a company's positive influence on social and environmental well-being against negative impacts and practices. I can give you an example for one particular issue, the types of information that we're looking for when we are seeking to identify institutional racism in company practices and diversity issues within a company's workforce. We are looking at data disclosures. So in the US, companies have had to file these things called EEO-1 reports to the Equal Employment Opportunity Commission. We're looking at additional data on retention, promotion rates, whether people of color and or women are promoted at the same rates as their white or male counterparts. We're looking into litigation related to harassment or other discrimination. We're also interested in if they have clauses in employment contracts that seek to waive an employee's right to seek outside counsel if they experience harassment or discrimination at work. Those are the arbitration clauses. We're looking at employee surveys, although to a lesser extent. Sometimes they're not that useful because surveys are completed and led by employees working in human resources, so it's not all that objective. The gender and racial and ethnic composition of a company's board is very telling. If a board is not diverse, that's often reflected in the ethos of the company and the emphasis on diversity, equity, and inclusion within the workforce. Then again, just because a board is diverse, it doesn't mean that things are great at the company either. We're interested in company policies, how companies are governed. Does the company have a nominating committee charter that explicitly calls for diverse candidates and inclusive non-discrimination hiring policies? Or corporate culture, how do you get to that almost intangible thing? How companies respond to public policy issues that are incongruent with the company's corporate culture. That can be demonstrative of whether a company is genuine in their intent to foster diversity. Also, the lobbying that companies do. Are they lobbying in support of policies that are destructive to racial issues? That is a very clear sign that there's a lack of commitment to racial justice issues. So that's just one facet of our ESG research process.
That's really fascinating. I could actually spend a lot more time just listing all the many faces that you look into. And just to clarify, these are also alpha drivers, right? You want to look at these factors, of course, because you do good, but they are pure alpha factors as well, right?
Absolutely. So that is the whole point of the ESG is to drive alpha. So if we thought this was just a social justice issue, that would be separate. But we're trying to figure out which companies get it, and the it can drive better corporate performance. And we've seen that, and many studies have shown that a diverse workforce is much stronger. It's much more resilient, and it can respond better to threats and opportunities. And so, what we are trying to do, and we've had some success in the shareholder advocacy part, to get large companies to really focus on this by tying it to their executive compensation goals. Because there is this war for talent, especially in the tech sector, and they need to be 5 steps ahead of everybody else to get the best and the brightest. We talk about how talent is equally distributed, but opportunities are not. So, how do companies really think about getting to those best and the brightest that others might have overlooked? And that will
And can
drive
you
the
give us,
alpha that we're looking for.
that's perfect. And can you give us an example of how you engaged with a company and the result that you saw?
Yeah, so a number of years ago, we engaged with Apple over this very issue, and we filed a shareholder proposal with the state of Rhode Island, the SEIU, the Service Employees Union here in the US, and engaged with them, filed a shareholder proposal. It got a pretty low vote because it was the first year. It was a fairly new proposal. But then about 6 months later, the company reached out to us and said, we need to talk about this because we actually have come to the conclusion that this is actually important and we need to do it. And they integrated it. I don't remember the exact details, but I think they changed their executive compensation policy, especially their cash bonus policy, to include sustainability factors with a focus on diversity, equity, and inclusion for their top
Wonderful.
executives.
Perfect example of how your shareholder engagement leads directly to change.
Mm.
And can you share with us how you decide which companies to engage with and which you do not want to bother? How do you view that choice?
Yeah, we have a pretty strong focus around workplace equity. I mentioned gender, race, ethnic diversity, equity, and inclusion, climate change, sustainable governance. So we're really thinking about intersectional risks and impacts. So gender and race, right? Or climate change and social impact. So we find an opportunity where investor action or voice is needed, then we can jump. In our impact report, usually over half of our engagements are on the social side of things. When we're doing our research and thinking about the ESG side of things, we're gaining insights through stakeholder consultations on those front lines of impact, as I described. We are identifying in that process areas where we think engagement could really help the company. And then once we have a company in our portfolio, typically we hold a fairly concentrated portfolio, about 30 to 50 equity names, and then we flesh out those efforts towards progress. And it's fairly iterative and an ongoing process. We're looking at these most material ESG factors to press for improvement. Then we're establishing goals for company change, and then we're monitoring and reporting on progress based on those goals.
And progress takes time, and you have to measure that progress. What else do you measure besides obviously a shareholder proposal being voted as a yes?
Yeah, and that's such a simple and not a very good way of measuring how has a company improved their practices in response to our advocacy. And then we also keep track of how our work supports the work of other groups, looking for these measurable outcomes. So it's really tricky to measure the impact in public markets, right? So we could attribute change to a resolution, like in the Apple scenario, but change usually is not typically the consequence of any one action. It's a cumulative impact brought on by the efforts of various constituencies. And we're part of many collaborative long-term efforts to create change, and we're often joining forces with investors and civil society groups to build support for dialogues so that everybody's input is amplified. Through our work, we hope to give power to other stakeholders stakeholders, both inside and outside of companies, to improve corporate behavior. So we use the concept of the 5 dimensions of impact in the impact management project, but that collaboration is really key. And just filing a shareholder proposal and counting that as a win is way too simplified. It's easy, but as I mentioned before, is the win the vote? Is the win that you withdrew it before it went to a shareholder proposal? Is it that you got the company to do something? Or is it that something actually changed for those stakeholder groups in future years? And how much did that change? So I think the industry needs to work on that a little bit more. And I don't know if there will be a clear answer.
It's helpful to understand the many layers of change and how it can take many shapes and forms. So it's a helpful color. And for individual investors, obviously you are a professional fund manager, but for individual investors listening today, what would be a way for them to have a voice in shareholder engagement as well?
So that's really tricky because as an individual investor, it's hard to catch the attention of corporate management. Sending emails and letters is useful to express support or disappointment. Obviously, investing with a manager that really does this work in an authentic way, because we can't do this work without our clients. So that's another way. And I think another interesting way that I don't think has been used very much is having an individual ask their financial advisor or their investment management company how, at least in the US, how they voted on certain shareholder proposals that are important to them. A good way to figure out, at least in the past shareholder season, which are the top kind of shareholder proposals, are looking at the ICCR proxy book. These are an amalgamation of some of the most important engagements on social and environmental issues in the US. And you can pull out, for example, a few proposals that resonate with you and ask your financial advisor, how did you vote on this for me? Or how did my mutual fund vote on this for me? That, at least the mutual fund voting, is public record in the US.
Yeah. And what was that called again? ICCR book?
Proxy voting book. There's another group in the US called As You Sow. They also have a proxy book that identifies some of the key shareholder proposals that focus on ESG issues. I think the other thing to be cognizant of is that in the US also there's a lot of anti-ESG shareholder proposals that look very similar to pro-ESG investment proposals. And hopefully if folks are interested in this work, they're not voting for those very right-wing type engagements.
So when you speak with management, what would be some examples of red flags where you might see that they're resistant to change, or any kind of warning signs you get while you do the engagement?
I guess the biggest one is if they don't want to talk to you at all. And that happens. And then we just have to keep on trying. But when you get them on a call, unfortunately now corporate counsel is in every meeting. It didn't used to be like that, but that can inhibit the discussion. I understand why they're on the calls from the corporate perspective. But when companies stick to their script and the language, and they're not willing to actually have a conversation, that's a warning sign. When they don't take stakeholder input and just use their own data, they deny what we're seeing. When we see lobbying against some of the key issues that we're worried about, I can give you an example. Amazon, for example, we've been engaging with them over years. There are so many sources that have revealed the company's continued pattern of anti-competitive behaviors, surveillance, micromanagement of workers, and poor health and safety records, especially in their warehouses. But the company disputes all of this, and they only use their own data to evaluate their performance. Last year, a Senate report alleged that Amazon regularly cherry picks data to report on the health impacts of its work quota requirements and ignores findings from other groups. OSHA in the US, they have done inspections and investigations, and they found that Amazon warehouse workers were twice as likely to get injured at an Amazon facility compared to the industry. And that's a fact that's supported by worker testimonies, but Amazon disputes this. So, that's a red flag that they haven't even internalized that there's a problem.
That's a great example.
I'd love to give another example of impact, if that's possible.
Yes, please.
Another successful engagement, when we talk about having impact, we talked about these kind of longer term changes that it sometimes takes a long time. But We have done work on paid sick leave in the US, and there's a very clear kind of before and after with a very measurable outcome of us removing an obstacle. So your listeners may be surprised to hear that in the US, almost 90% of private sector workers don't have access to a single day of paid family leave. 1 in 4 new mothers returns to work just 10 days after giving birth. I don't know if I could walk 10 days after giving birth. This is a
That is so
huge,
depressing.
it's absolutely insane, right? This is a huge problem for companies. It's expensive to give paid family leave, but what we have seen is that companies that offer paid family leave to workers, all workers, not just those at the top, they're reporting improved morale, cost savings from less employee turnover. But what it's telling you is that when virtually all low income working Americans still have no access to paid family leave, that's where a company is. It's like one of those signals on corporate culture. Who is a company valuing,
Mm.
right? So also LGBTQ plus workers are also extra harmed by this because there are many policies, corporate policies exclude adoptive parents. LGBTQ plus workers, they are much more likely to parent adopted children and raise
Mhm.
foster kids. And again, that's a really important distinction as well. A number of years ago, we developed an investor engagement plan aimed at moving companies to address this issue. And so we met with employers, we worked with a nonprofit to develop benchmarks for company presidents. And the 3 things that we're really interested in is, are the employer's policies equal between different classes of employees, salaried, hourly, full-time, part-time, that kind of thing, regardless of gender or family circumstances? Are they adequate in terms of length, in terms for the health of the children and the bonding time that's needed? And are they accessible? Do employees know how to access this? So we wrote to more than a dozen firms who felt that their policies were inadequate, and then filed in conjunction with a few others some shareholder policies or shareholder proposals asking companies to improve their approaches, and got some really great results at a number of companies that affected many thousands of people pretty quickly. So we're really proud of that work.
Fantastic. Fantastic. That's the real impact making. Thank you for sharing. And do you think there's some sectors? I mean, you mentioned Amazon, that's like company specific, but do you think there are some sectors or industries that are more resistant to change than others?
Yes, I think those that are entrenched in short-term profit making, those that don't see the long term, those that are the most extractive or in the most competitive field, the most resistance are the ones that are most threatened by this kind of focus on the future. So I think companies, when they are threatened, get very strange in their behavior. That I think that's just a natural defensive response. For example, Exxon, right? I don't know if you're aware, but they sued 2 of their shareholders a few years ago for a shareholder proposal on climate risk. That is not normal company behavior, right? If a shareholder proposal is important, it will be voted on by investors. If it's not important, it will die a death. But for Exxon to feel so threatened by these small investors that they had to sue them, that's an interesting threat response. AI is another area where I think things are interesting. And because it's so competitive, nobody is willing to step back and think about, do we really need to grow at all costs? What are the threats and the risks for doing the work that we do?
That's an interesting point that I think a lot of firms will have to think about, also shareholders as well. And before we go, I would love to hear your 5-year outlook for socially responsible investing and impact investing. What is your prediction?
Yeah, I think there's definitely a dichotomy between what's happening in Europe and what's happening in the US. And the US, we're going back to our roots. Many people in this industry weren't around, they weren't here 10 or 20 years ago, but we are used to facing this kind of onslaught and not being fashionable or trendy. I think doing what we do, staying strong, working together towards having more social impact is going to be key. It's interesting that companies that we're engaging with since the presidential election have still been fairly positive. The discussions have been productive, but I think both companies and investors are going to be much more aligned on how they work together. And those relationships will keep us going towards better social progress after this administration is over.
Great. It'll be interesting to see what the future holds, but definitely interesting and challenging times ahead, as you said, depending on where you're based. And I will call this a wrap, even though I would love to keep going. Sonia, thank you so much for joining us on the podcast and for the wonderful insights on impact and socially responsible investing that you shared with us.
My pleasure. Thank you, Margarita, for having me.
Thank you. You're a true role model. And thank you all for listening to the Investing in Other Stories podcast. If you enjoyed this content, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow me, Margarita Tr, on LinkedIn or at Finance Latte on Instagram, and Sonia Kowal on LinkedIn. Cheers and see you next time. The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Tr, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.